and we'll hand it over to everyone to share with you about strategies. Before we start, I would like to give you a brief introduction about Urix Exchange. Let me just share. Okay, yeah. So we are one of the world's leading derivatives exchanges, offering a broad range of international benchmark products. We are part of the Deutsche Börse Group, headquartered in Germany, which offers a broad product and service range, such as derivatives trading and clearing services to the clients through Urix, the European Energy Exchange, EEX, and Urix Clearing. Urix, we offer more than 2,400 products covering all major as well as alternative asset classes, such as futures and options on equity, equity index, interest rate, dividend, volatility, and FX futures. So looking at the equity index benchmark products, we have Eurostop 50, DAX, MSCI, ESG, and volatility futures, which I'll briefly go through later. Prior to 2018, Urix trading was only available during European hours. But to provide coverage of the Asian time zone, we extended the trading hours in December 2018 on benchmark equity index and fixed income products. So on the right, you can see that Urix trading starts from 8 o'clock in the morning Singapore time until 5 a.m. the next day. So it is 21 hours trading to support the increasing demand of our clients for trading on a global marketplace. As mentioned earlier, Urix first started the trading hours extension to cover the Asian time zone since 2018 for selected equity index and fixed income products, such as the Eurostop 50, DAX, Mini DAX, all MSCI futures, and the fixed income products. And driven by strong client demand, we further extended the product scope in 2020, as you can see here, phase 2, to cover Eurostop's banks futures, Stoxx 600, VSTOXX, the volatility futures, and French bond futures. And in April last year, Urix launched a suite of micro futures on 3 key European benchmarks, which are the micro Eurostop 50 futures, micro DAX futures, as well as the micro SMI, the Swiss market index. Of these 3 products, micro Eurostop 50 futures and micro DAX futures are available for trading during Asian hours. The value of one index point is €1 for micro DAX futures as well as the micro Eurostop 50. So here I would like to zoom into the benchmark equity index futures, which is the Eurostop 50. So what is Eurostop 50? Eurostop 50 index covers 50 largest companies from 8 Eurozone countries and provides a blue chip representation of super sector leaders in the region. It consists of the companies which we are very familiar, such as LVMH, which own brands such as LV, Dior, and etc. Eurostop 50 also consists companies like Philips, BMW, Adidas, Airbus Group, Deutsche Börse, and etc. In February this year, the average daily volume stands at 1.88 million lots, and it is the most heavily traded product at Urix. So it is the benchmark for stock market performance in the Eurozone and among the most liquid futures in the world. And most importantly, it is tradable during Asian hours. So next, I move on to DAX futures and options. So just now I talked about Eurostop 50, which is the benchmark in the Eurozone. Here we have DAX that measures the performance of the 40 largest companies on the German stock market. It consists companies such as Continental, SAP, Allianz, and etc. The DAX index is the benchmark index for the German equity market with an average daily volume of 141,000 lots, and it is also tradable during Asian hours. So what is the liquidity like during Asian hours? On the left, it shows the spread comparison between Asian hours and the core European hours. As you can see, most of the contracts are trading at very attractive spreads and as competitive as a spread during European hours. This is because we have sufficient support from our market makers to be in the order book to ensure liquidity and tight spreads. And why is it important to have liquid order book? Because liquid order book helps investors to better hedge and risk manage their portfolios in Asian time zones. This includes being able to react globally to major market news as it happens, hedge against geopolitical uncertainties, and adjust accordingly ahead of economic releases and announcements. And this slide shows the average daily volume of the selected equity index derivatives at Eurex, which include the Eurostop 50 DAX futures that I mentioned, as well as the volatility index futures and the Korean index futures. The last slide on fixed income products we have and the average daily volume. So I've come to the end of my presentation. Please feel free to reach out to Tiger Brokers if you are keen to find out more about the products. With that, I would like to hand over to Kon Hao to share with you the trading strategies. Over to you, Kon Hao.
Thank you, Hui Si. Just give me a moment to share my screen. All right, so thank you, Hui Si and Tiger Broker, for having us for this talk, investing between the West, US, and the Europe. So today I'll mainly talk about investment strategy. And then for next week, we're going to continue with this series. I will focus on the trading strategy for the Eurex market. Now, I think let me just give you a background of a framework of what I'll be covering tonight. So what you, for the next maybe about 40 minutes as I present, you have an idea where we're heading right into. So this is a disclaimer from Tiger Broker. And the framework that I'm going to share today will be, the first part I'm going to talk about the characteristic between the US market and the European market. Now, I think most of us are very familiar with the characteristic of the US market, NASDAQ, Dow Jones, S&P Russell. But I think a lot of us Asian traders, investors, were quite unfamiliar with the European market. I'll share with you what the characteristic and where are the opportunities. And of course, the hot topic in the recent month, it will be the interest rate hike. But I would say that this time, the hike is so different. It's so different. I'm going to explain to you why. And again, towards the end, I'll lead to how to mitigate the risk and where's the opportunity. So of course, when the interest rates start to trend up, definitely it will impact the whole world. Why it first started from US, there will be a lot of headwinds, definitely. And of course, US is still the largest market. It will also flow over and affect the European market and the rest of the world as well. So I'm going to talk briefly about that. Then, of course, the key is we know that the headwind for 2022 and maybe beyond will be there because of the interest rate hike. The trend is trending up. So how really to mitigate the risk and exactly where to find the opportunity. So we're going to discuss about all this. Just want to get you excited about what we'll be sharing tonight. Okay, let me just move on to the first part for today program, investing between the West, US, and Europe. For those that just join us, do join us next week. I'll be talking about trading between the West, US, and especially on the European market. So it'll be applicable to both markets, but my focus will be on the Eurex market. Now, the first part is that I'm going to share with you the characteristic between the US market and the European market. So what are the characteristics? Now, I started my journey in this career. Yeah, I was an engineering student, but I never practiced that. So I started a career. So I jumped straight from engineering student to, in 1995, I joined the CIMEX trading floor back then as an apprentice. So in 1997, I joined Bank of America. So that's, I'm taking a break during the Asia crisis, the crisis that's happening on the trading floor. So we just took a little short break just to take a picture together. That was in 1997. And let me just go through the history that I could remember back in those years, from 95 to the recent years. Now, so that's Dow Jones. And if I'm going to look at the whole market since about 25, 30 years ago for Dow Jones, how many times have it multiplied? I would say that first, let me just look at Dow Jones, the US market, you could see that the market over the last, since 95 to about 2011, has been range bound at about 10,000. So I just take it as, since in the market, I believe that most of us started during this period. And of course, those that born later will join in much later. But let me just recap the history that I know I experienced it. Now, the market, the average has been about 10,000 over the last many years. And over this period, since about 2011, it has multiplied about 3.6 times. That's for Dow Jones. And I want to look at it very closely here, the characteristic between the Dow Jones, S&P, and NASDAQ. Now, what is Dow Jones' characteristic here is, my key here is there's a lot of diversification in terms of sectors and industry, as you could see that. S&P, to me, is the top 8 is still really heavy on technology. And only the rank number 8 is Berkshire Hathaway. That's an investment holding company. And of course, NASDAQ, all of them are the high-tech companies. So now I want to focus on the weighting, the segmentation. Dow Jones mainly are very diversified, which is a good thing for uncertain market, which I'm going to explain to you very, very shortly. Why is that so? Now, how about NASDAQ? Now, NASDAQ since 1995, since I first joined the industry to today, I would say that for NASDAQ, yeah, we've been through the bubble in year 2000. I was there on the trading floor. Now, by then, it's already on the as a dealer. Now, anyway, for the last many years, you could see that if I'm just going to draw an average line, it's about 2,000 points. Now, over the last many years, since about 2011, NASDAQ have multiplied to about 8.4 times. Now, remember, Dow Jones were 3.6, and NASDAQ is 8.4 times over the span of last 1 decade. Now, let's look at the German DAX 40. About 1.5 years ago, just German DAX 30 for the longest time. So basically, German DAX is the German index itself. Now, I think I suspect they recognize that market will get very volatile, but they always pursue for a very balanced representation that represent the German stock market. So last about 1.5 years ago, they reshuffle the whole index, and now it's a German DAX 40, because what I've read on the website is that they want it to be very diversified to best represent the German market itself. So that's German DAX 40. As you can see, I want to focus on the different sectors that represent German DAX 40. And I think in tough times, it's very important what other sector will do well, or at least very cushioned in tough time, is the basic materials, consumable products, something like that. I think during this tough time, I will focus on that. And especially during this period, I think I also would like to focus on the commodity counters as well. Yeah, because inflation is, I think, will be here to stay. Now let's look at German index. Now you will have recognized I specialize in behavioral science or market psychology. So now we recognize that Dow Jones is a basket of industries. It's not just heavy on one sector, right? And German DAX is very similar to Dow Jones. Now let's look at the behavior over the last 25 years. So same thing, the market from 1995 to about 2011 has been range bound. If I draw an average line, it's about 5,000 points. Now, since it's diversified, what happened to over the last 10 plus years, that the market have also moved up by 3.5 times. Remember Dow Jones earlier, because of the diversified nature, this composition have multiplied 3.6 times, and German DAX also the same, multiplied by 3.3 times. So do you see that relationship? So of course, during a bull market, depending on what sector is being focused on, diversification is not the right strategy. But during an uncertain market and when the economy have a lot of headwinds, now as an investor, I would like to focus on diversification. So that's my key, where I'll explain to you on this investment strategy later on. Yeah, because we have quite a bit of content to cover. Now let's look at the something that excites me even more beyond German DAX or Dow Jones is, in a time of uncertainty, will be Eurostop 50 index. So naturally, it represents 50 super sector. So they really hunt down the best sector of not just Germany, but European market. Different countries. Now, focus on the different sectors. As you can see, they call them the super sector. And the other plus point is beyond super sector is like diversification over diversification. That's why I see the attributes of Eurostop 50 in a time of uncertainty. And there's also countries, different countries made up of this whole European nation, right? So that's why I call it a diversification within diversification, super sector and different countries. And out of this, these are the top few, and just this top few, it represents 41.7% of the whole Eurostop 50 index. Now, for Eurostop 50 index, these are the top 10. As you could see that the technology is number 1 and consumable product is number 2, which I like it a lot in a time of uncertainty. Because in a time of uncertainty, earlier I mentioned, is that consumable product is because we still have to consume somehow. Okay, the basic product, it is important. Now, then in terms of the country weighting the top, all the 50, and you could see that the France and Germany and Netherlands are the heavy weighted ones. The rest are a fraction of it, the makeup of the whole Eurostop 50 index. So I would say that is very well represented. For Eurostop 50 if you want to look at the European, how are they doing today, you could consider to look at Eurostop 50 index. Now let's look at Eurostop 50 index. Earlier we mentioned about, I show you the dynamics of the whole market from US, the 3 markets, to German markets. Now let's look at the Eurostop 50. What have they been doing over the last 25 years or 30 years? Now, you will realize that the Eurostop 50 markets has been, if I'm going to average it, have it trend at all? The answer is no, you have not trend at all. Why? Because it's very diversified with different sector and many nations that made up of Eurostop 50. Now, it may not be a bad thing when the market is uncertain. Now, let me share with you how it works. Now, when the market is bullish over the last 10 over years, it may not be very productive if you are a passive investor. Now, let me just talk about this investing strategy for Eurostop 50. You have to understand the nature of Eurostop 50 is very similar to Singapore STI, that over the last many years, the last 25 years, 30 years, STI has been range bound between about 2005 to 3005. Yeah, because I'm a Singaporean, I know that maybe outside Singapore, many of you are listening in. But same thing for Eurostop 50, the attribute is that it's also very diversified in terms of sectors and nations. Now, therefore, it have this attributes that is range bound. It's range bound. Now, range bound may not be a bad thing. You should not be too passive. If you look closer, that you recognize that it's a very diversified product nature or index nature, there's a tendency that you're range bound. Now, range bound, if you focus very closely, where's the investing opportunity here is that, do you realize that it moves in cycle, and every about 3 or 4 years, it moves in one complete cycle. Now, usually for a very diversified index or investment policy that I have, when I look at a very diversified benchmark, how I do is that I will start to accumulate around the range low and start to exit around the range high, knowing that it's very diversified. And at this point in time, I would say that the market, you can see that it's around the range top. And I will start to cash out the investment opportunity and maybe turn short. And that's where next week, I will talk about the trading strategy for the Urix market. And for investing, I will just wait upon when opportunities start to come by again. I do not know, maybe nearing to about 2008, I will start to accumulate all these stocks once again. Okay, so that's something about investing strategy here. Now let's look at the timeline for Eurostop 50 on the when did it got started. So it's a long history. In 1998, I love history because once you have data, you can study into the behavior of the market itself. Now, 1998, in February 26, it started Eurostop 50, and that's even before the launch of the euros. Now, the first time they launched the euros currency, it was in 1999, 1st of June. And then it comprised of, the composition is reviewed annually in September. And what else? Now, it provides a blue chip representation of super sector leaders in the region. That's what I've spoken about. And it has 50 leading blue chip stocks in the Eurozone country. I just got to move fast because I want to tackle the rest of the topic tonight. Now, so let me ask you a question. You don't have to reply me, but you have to know this. What is the number one enemy for the financial markets? What's the number one enemy for the financial market? Is it a virus, or is it Russia and Ukraine war? So what is the number one enemy in the recent years or recent month for the financial market? And my answer is this. What is it? It is the interest rate trend. Now, notice I mentioned the word trend. It's not just hike. Interest rate hike is just a hike. But interest rate trend, it is something that we should be, as an investor, that we should be very concerned, because many hiked over a period of time. It formed a trend. Now, so far in the history of the last 40 years, we have not encountered that many hiked over a period of time. We have an uptrend in interest rate. Now, all this while over the last 40 years, it was a downtrend of interest rate. And that's, to me, as an investor, is definitely not a good news to be an investor, because we will encounter a lot of headwinds in the equities. Now, let me explain to you a little bit deeper about the interest rate. Now, why this time the hike, it is so different. Earlier, I just complete the first segment. The first segment, we're able to see the characteristic between a diversified and a very focused benchmark. So diversity is good. So later on, I'll drill a little bit deeper. Let me just cover some fundamental here. That's what's happening around. Why this time, the height, it is so different. Now, we have to understand the relationship. As you could see that this is at least more than 40 years of data. And on the upper window, we have the interest rate. And on the lower window, it is the stock index, is Dow Jones. It represents the Dow Jones. I will come back to the European market very shortly. I just want you to see the relationship between the interest rate and the stock market. Can you see the relationship between the two of them? Now, when the interest rate is on a downtrend over the last 40 years, now what will happen to the stock market, the asset class around the world? The asset class will go up. Okay, it's a very natural progression effect that when interest rate is lower, assets will appreciate. Now, what's the difference between a hike and a trend? Now, a lot of us do not quite understand, because we cannot differentiate between interest rate hike and trend. Is this? Now, a hike is, the peak is started in 1982. Yeah, the interest rate peak. But along the timeline over the last 40 years, it was a downtrend for interest rate. And there again, the asset class has been moving up over the last 40 years. Now, what's the difference between a hike and a trend? Over the last 40 years, interest rate is moving in a downtrend. So we have to understand that. And then intermittently, over the last 40 years, there were interest rate hike just for a few months or maybe a year, then they stopped, then it continued to move on the downtrend. So over the last 40 years, interest rate was moving on a downtrend. Therefore, over the last 40 years, asset class, including property prices, has been moving up. And that's the reason. Now, the next question is this. I think it will be quite intriguing for many of us, that I was 10 years old in 1982. Now, what I'm trying to say here is that my experience growing up, I experienced that it seems to me that the assets will only appreciate. So I have this idea that assets will only appreciate. So until I understand about interest rate trend, then I begin to realize that that may not be the case. Okay. Now, you have to understand that I grew up believing that this is going to happen, but let me just share with you what happened next year. Now, so how old were you when you're in 1982? Maybe you're much later. It means that all our life, we have experienced that asset class will only go up. So is it really true? Let's examine a little bit deeper here. Now, between these two gentlemen, Benjamin Graham and Warren Buffett, they are both investors. I have this question. Of course, Benjamin Graham is the teacher, or was the teacher of Warren Buffett. Okay, so one is student and one is teacher. Now, my question to you is that who is smarter? Now, whenever I ask this question, a lot of us will be scratching our head. Yeah, exactly. Who is smarter? Is it Benjamin Graham or is it Warren Buffett? Can I tell you this, that I think that both men are as smart maybe I suspect that Benjamin Graham may be smarter than Warren Buffett because he's teaching Warren Buffett. But, it doesn't really matter who is smarter. What I'm trying to share with you is this. It also depends on, if you're very good with your investment, you have all this knowledge, you also depend on the opportunity of the whole market cycle at the point in time. Now, I want you to take a look at this illustration here. Let me just shift myself out of the way from Mr. Benjamin Graham. Okay, so now you could see that in 1944, he was 50 years old. Yeah, so you can see the 1944. So the market been through one whole cycle. It didn't go up. It did go up, but not that exceptional from the last 20 years that we experienced. Then he died at the age of 1982, and that was in 1976. Now, so as the market come down before he died, passed away, the market kind of just appreciates slightly. So what I'm trying to say here, that as a 50 years old matured man with wealth experience, with good saving, I would say, but market don't really offer much opportunity to him during his era compared to Warren Buffett, which is his student. Now let's look at Warren Buffett. Now, so Warren Buffett, 50 years old, when he was 50 years old in 1980. Now, 1980 also offered him the best opportunity in someone as investor, if you are a savvy investor. So he also born at the right time, right season, at the right age, and born at the right time. Market give him the best opportunity. As you could see, over the last 40 years, the market has multiplied by 14 times. That's what I'm trying to say here. Now, there's another opportunity that's coming up that I'm going to share with you, because one market may be having headwind, the other market may be having a good time. Now, I'm going to share with you very shortly how it works. So what I'm trying to represent here is that do not get too overwhelmed that having this idea that if I buy assets, I borrow money, I buy assets, it will definitely go up. So I think that's a very dangerous thinking. That really depends. Yeah. Now, let me just drill a little bit deeper about this interest rate. And now I'm going to talk about inflation. Yeah. So why this time the height, it is so different? I think I can call myself to come down a little bit here. Yeah, okay. Now, why this time the height is so different? Why is it so? Okay, so we understand about the difference between the height and the trend. Okay, I suspect that the inflation is not just going to be a 2022 thing, but next year in 2023, or maybe the next few years, the inflation is going to be continuous. Now, as the inflation is going to be continuous, interest rate hike will also going to be continuous. And if you have read the recent news, I think the Fed has been getting more and more aggressive. After the first hike in March, they say that the next 6 meetings, they're going to have interest rate hike again. And the news I read this morning, they say that each time, maybe they're going to hike 50 basis points. So can you imagine for the next 6 hike for 2022, another 50 basis point for each hike, that would be add up to the next 6, 3%. And that's a lot. So they're sending us a signal that inflation is there, here to stay, and they're monitoring it very, very closely. They're doing a very responsible thing. They have to hike interest rate. So my concern that you got to ask yourself as an investor, because inflation is important. Interest rate is the key to all investment. So you got to ask yourself the next 2, 3, 5 years, because investor, we talk about long term, is the inflation going to persist? If the answer is yes, then I think we're heading for an interest rate trend, uptrend. It's not just hike. So now you can see the difference between a hike and a trend. And over the last 40 years, we have experienced that, yeah, every hike, the market will still go up. Yes, it's true. Every hike, the market still go up because it was hike on a downtrend. But moving forward, I suspect that this interest rate may no longer stay on the downtrend. It may transit to an uptrend. So that's the difference. Now, let's look at it in the stock market, in an equity class. When interest rate is higher, definitely for asset class, we will face a lot of headwinds, or rather. Now let's look at this sequence here. What caused the persisting, I think should be persistent, right? What caused the persistent inflation? Is it a virus, or is it the Russia-Ukraine war, or something else? Now, the persistence of the inflation that we're all experiencing is, let me just rearrange the order. I think before the virus and Russia-Ukraine war, there's something else. Then after the virus and Russia-Ukraine war, there's something else before the interest rate trend go higher. Let me just explore part by part. So we're able to understand what is the very real danger that's ahead of us, but where is the opportunity that's more important, how to mitigate this risk. Now, before that, what is the number one issue that caused the persistent inflation that we are facing today? Now, it is the debt, the US debt. Okay, now this US debt, we all know it all the while. It's nothing new, but let me explain to you, there's a difference between a good debt and a bad debt. Okay, now, so what's a good debt? We all have experienced that I think most of us have had the experience. If not, you may have read what happened to the 2008 Lehman crisis. Now, in an expanding economy, so US is ever expanding. So it's in an expanding economy, it is good to borrow money to have expansion. So there's difference between a good debt and a bad debt. So during those years when US economy need to expand, it's good to borrow money. So there's good debt and bad debt. So personally, there's also good debt and bad debt. So you have to time the market, know the cycle, when to borrow money and when to borrow money. So even personally, I do that as well. When to leverage and when not to leverage. Now, here comes 2008. Now, I said earlier that to expand the economy, it is necessary to have some debt. That's a good debt. But here comes 2008. Now, 2008, we all know what happened to it. It was first started with subprime crisis, then followed by Lehman crisis. Now, what happened to that? They increased the debt, they print more money, and it created a problem. Now, it became a bad debt. Now, when I say a bad debt is this, if you borrow money or print money to sustain your economy, and that exactly was happening back then. In 2008, when subprime crisis happened, so what Fed do is they started QE 1, 2, and 3. So basically, what's QE? Then I remember that as an industry player, I do not know what is QE. We were lost with the QE 1. We do not understand what is QE. Only subsequently we know what is QE. Basically, it's just printing money. Now, so is increase in debt to sustain. You still remember the term they say it's too big to fail. So we have to do that to sustain the economy. When in the expansion of economy, you borrow money, that's good. But to sustain a lifestyle and you borrow money, that's what I call bad debt. Now, since about 2008, of course, it will take, in a macro analysis, all this will take some time to create a deeper crack. Now, so what happened here is that the first one is the debt will cause inflation and ultimately increase interest rates. So that one we understand. Now, then here comes virus about 2 years plus then. And so what happened here that you can see on the chart since 2020, the money was even printed even more. And that create another set of problem. The more debt you have, basically you print more money, it causes the US dollars to have dilution. When the currency is being diluted, basically everything inflate. Then you may say that by it's US dollars, but why all over the world is having inflation? Very simple reason is because of US dollars is a reserve currency. So all of us trade with US dollars. So in a way, the US dollars has to be exported out. When US dollars being exported out, it also means that the inflation will be exported out. And that's the reason that all over the world, we're seeing an increase in inflation, especially if you look very closely since March 2020, all over the world, we're seeing price increase. Now, then, of course, here comes Russia and Ukraine war. It doesn't help. With the virus, it caused a lot of a supply chain issue. It add to the problem. But with Russia-Ukraine war, it add another level of supply chain issue. So it doesn't help. And that will lead to what? That produce inflation. Then number 2, virus. Number 3, Russia-Ukraine war. And number 4, now between 2 and 3, they are the catalyst of what? Catalyst of more inflation. And that's why I say that I think this inflation, because it's been over the last few decades, it's been built up. So I think it's not going to solve within the next 1 or 2 years. It's a issue that I think the Fed will have a very difficult job to do. It's a noble job to me as well. But I think it will be very tough for them to make a decision. And that's why I think they have made it very clear. They have to hike the interest rate. And we just have to prepare as an investor what is going to come ahead of us. Now, so we understand about when the interest rates start to trend out, asset class will face a lot of headwinds. Now, how to track inflation basically are, to me, in my opinion, are two things that I will usually look at: CPI and currency as well. Okay, so therefore, having a strong currency is important in time like this. Now, basically, what you could see that CPI in February it reached the highest number at that 7.9 for US. And if I'm going to draw, we studied about 1982 earlier, that you could see that was the first time that you have reached before 1980. Yeah, then we study the market, what happened to that. So this is one thing. So inflation is there. So we can look at this number from time to time to understand about the market. So I hope that you will come down the CPI. If it's going to be continuously moving uptrend, then definitely the trend of the interest rate hike will continue. Now, then the other one is the currency, and the US currency maintains strong. My answer is not quite. But of course, if you're going to compare to the OECD nation, they're in the same mode of printing money as well. So there's not much comparison if you look at between those currency pair. But I would like to compare between the two strongest economy powerhouse here, which is between US and China. Yeah, so they produce the most number of GDP. Now, if I'm going to compare the US dollars and China yuan, if you see that over the last few years, about when and before and after the COVID started, in fact, the US dollars have depreciated against the China yuan for about 12%. So basically, the theory is that when the currency is weak, so you have to, you're going to expect more inflation to come. Yeah, it's important to have a strong currency during a time of inflation. Okay, let's look at the next slide here. Now, how is it going to impact the US and European market? Definitely with uptrend in interest rate is going to impact all the markets. But of course, you will start with US, then the rest, all the central bank, when US central bank hike interest rate, all will follow as well. Okay, to make yourself more competitive, likely all will follow. So we study about what's the number one enemy of the financial market. So we go through this flow. Yeah. So I hope that you like it, to give you a insight and a perspective why it is so important this time around. It's not just any other hike, but it's an interest rate trend that I'm talking about. It's not just hike, but it's trend. So please remember that. Keep track. I'm glad that there's recording here, because in few years down the road that you could review this video, I think it's still very applicable in the next few years. Yeah. Now, let's look at very technical, and do join us for next week. I'm going to go into very technical because I'm going to talk about trading in the European market. Yeah. But let's go back to investment. Now, what happened here is that, let me just give you a timeline of what is unfolding. The last few months was very a significant month because it gave us a lot of information. Just now, I just talked about the fundamental macro development. Now I'm going to give you a timeline to unpack everything, including technical as well, how well it gelled together. Now, in December, this is the first time that we saw that the Fed mentioned that inflation is not transitory. Now, before December 2021, the Fed said that inflation was transitory. It means that because of COVID lockdown, they open up the economy, they suspect that inflation is caused by, there's a floodgate of people making business transaction, shopping transaction. It caused inflation and it will be short term. But in December, they prepare the environment. They say that no, inflation is not transitory. So in March, they start to increase interest rate. Now, I prepared this about a month ago. Yeah, because there's compliance that need to clear all this and that. So when I prepare again this afternoon. I thought to update the chart, but then I said that no, I think I should leave it there because that was my view on the 28th of February 2022. Then you're able to see how things start to unfold. Now, so what happened here is that in January, we have this, for the first time, inflation CPI crossed above 7%. Of course, February became 7.9. And then February, we have the Russia-Ukraine war. And then we have March, we have the Fed hike rate for the very first time since September 2018. Now, so that's what is unfolding, fundamental development. Yeah, but we know the background of it. Earlier, I mentioned that. And then technically, now we go to technical. And I could see that there was a very nice hammer being formed. Yeah, excellent hammer. So I suspect that the next few weeks on the 28th of February 2022, market will have to rebound. Now, when the market rebound, my idea was I wanted to come so that I can start to cash out my holding. So, which I'm glad it came. So, yeah. So technical is important for investor as well. So if you're an investor, you're not using technical, you may consider to use technical as well. Now, so I have this forum. I say that for long-term position purchase years back, my strategy on any rebound. So on this 7th of March, I posted on this forum that we saw a hammer, which is very important. That I suspect that on any rebound, I would likely start cashing out partial or mostly those long-term positions that I have purchased years back. So because of its potential risk in the longer term that we explained earlier, in short, any rebound is an opportunity for me to make the exits and not to indulge for another ride. So things are different. You have to take the opportunity right now or even turn short. So do get to know about derivatives. So next week, I'm going to talk about how to short the market and how to hedge the market as well. Right. Now, let's look at the technical for NASDAQ market. Okay. Now, if I'm going to combine all the best trend line on this uptrend over the past many months for the US market, so what happened at the beginning of January is start to crack, it start to break. It's beyond that. Usually how I do look at market as an investor or trader is that I use technical, then of course I know about the macro, so I read news, I try to make sense. If the technical telling me something, I'll try to match whether the macro is developing that as well. So you can see how things are gelled together. Yeah. So that's for NASDAQ. And let's look at the German DAX 40. So what happened here is that now how to draw uptrend line is basically you look for the best match. Yeah, the best match. Now, I could see that the uptrend line was quite nice over this period of time, but the German DAX start to tank somewhere in October last year. So it's a bit leading compared to the US market. You start to tank. And of course, January 2022 and onwards, you start to sink. Now, so it kind of broke the main uptrend line. So technically, that's what we're seeing here. And let's look at the Eurostop 50 as well. If I'm going to draw the uptrend line, you could see it, very nice uptrend line. It also broke at the beginning of this year, 2022. Now, so how are we going to mitigate the risks to find opportunity? First, we need to understand how to mitigate this risk. Two, then later to find opportunity. Now, so it's very simple logic I have here. Now, if you know that there is a pending bull about to come. Now, what I mean pending bulls is like, I experienced the dot-com bubble before. So after that, the market kind of range bound for a while. But back in my mind back then, I believed that the e-commerce will one day pick up. Yeah, so in 2000, the millennium, they tried, but they failed. But it took the whole market about 11 years. In 2011, the e-commerce finally started to take shape. Yeah, so it started to pick up. So during that period, we look at the fundamental, I look at the technical as well. And I know that it's perhaps to be there at the beginning of a bull market. Now, if you're in this mode that you know that there's a pending bull, we got to stay focused on maybe a few sectors that will benefit from this bull, or maybe a few markets. That's what how I invest in different benchmark and different places. Yeah. So now the the technique is this, the investing technique is this. You have to have able to discern that where is the pending bull that's coming up, okay, the pending bull. Now, if it's going to happen, what you should do is to focus on the sector, the few sector. Just take some risk and invest in it. But today, our topic is that we study that the market moving forward is going to be quite uncertain. So in an uncertain market, what should we do? So that's the NASDAQ that you could see that I mentioned about after 2011, the development that's going on technically that was there as well. And over the last 10 over years, it went up by 8.4 times. Now, what happened that when the market is uncertain? Now, then as an investor, I have to look at this. I have to diversify. Diversification is the key when the market is uncertain. Now, so we have to focus on diversification. Now, earlier I say we studied the German DAX 40, but I say that in time like this, if you still remember, that I prefer the Eurostop 50. If you ask me to look at the West today and moving forward, I'll be very interested in the European market. Why? Because they have the super sector, is diversified as you could see here. And the country weighting, there is also a diversification within the diversification here. There's not just one country, but many European nations that made up of the whole Eurostop 50 index. And they are also a good dividend payer as well. This one, I think I'm blocking the way. You may not like me. Let me just shift myself out of the way. Now, so you can study that there are 6.5% and there are many 2% that dividend payout. So they are famous for that. So that's one good thing. As the market range bound, earlier we studied about the nature of the European stock 50 market is that it tends to have this wide range, but wide range, there's cycle, which is good. But in the same time, if you're holding to all these stocks, they also pay good dividends as well. Now, so the strategy, again, for those that just join us or join us much later, the strategy is this for Eurostop 50 for investor is that I want to focus that you have to understand that when the market is have this diversification in nature, basically is that when the whole market move up, I'm talking about the US market, it will also move up, but in terms of the magnitude, it will not move up a lot. But similarly or reversely, when the market starts to trend down, say for example, the US market, but because of the very diversified nature, the European market will not it will not move down in the same magnitude as the US market as well. So that's an attribute that I want you to see here, where I believe that I'm using these techniques all this while. And the next thing is that if you look closely, there are cycle within this whole period, and it's about 2 to 3 year cycle. So around the range of top, you try to cash out in a stock market, and no harm to take a look to short in the derivative market as well. So which is the topic I'll be talking about next week, some trading strategy that you may be interested in, and also to hedge. Now, how to hedge in a very uncertain time. So I'm going to give you some example about you're still holding the stocks because sometimes the market may come quite quick. How are you going to hedge your existing holding using derivatives? Now, let me just move on to the next question. Next slide here. So that's German DAX. And if you've been following Tiger Broker for the last few seasons, I mentioned about there are stages in every cycle for almost all the market. So I talk about income, value, growth, but I haven't talked about decline stage. So I highly suspect that moving forward the next few years, the whole market is going to be pretty challenging. And perhaps there's an opportunity that market may be moving into a decline stage. Very possible. Why? Because of the interest rate trend. So I'm just preparing you that what I know, but along the timeline, you're going to see development about inflation is very important. Then you're going to study into the interest rate trend, not just the hike. If the interest rate trend is going to start to be continuous, that's important. Now, then let's go back to look at the Eurostop 50. Now, very interesting, Eurostop 50, let's look at it right now. Now, let me just size down a little bit for the Eurostop 50. And you'll understand that for Eurostop 50, all this while, since it started in the before 2000, it was in this range bound. Yeah, so we study about the range bound market. It may not be a bad thing. So range bound market as an investor, you have to apply the range bound strategy. So please do not be passive. Passive means that I like a stock, I buy and hold it forever, and then you'll be a very angry investor. But you have to recognize as an investor, it's a range bound market. You perform as an active investor. Range top, you cash out. Around the range low, you start to accumulate the good stocks. That's how you do it. Recognize the market, its nature, its characteristic, and you perform the right strategy for that type of benchmark. Now, so the next big question that I have to ask myself, that this is an income stage. Will it ever, the European Stock 50 index or the benchmark, will it ever enter into a value or a growth stage? Now, before I enter a growth stage, let's talk about value. Will it ever break this range? Now, it really depends. That's what I'm saying. That's how, when I invest, I'll ask myself this question. Yes, is now at the income stage, will it ever go to a value? If the value is sustainable, it may enter into a growth stage, which is really exciting. Now, that's why I see in NASDAQ back then. Okay. Now, let's look at the value stage first. Now, the key question is this, which I'm quite delighted as I present this topic. So I did some research and I happened to come into understanding about the European Union, what is their mandate. And I like what I read. Now, let me just read to you. It say that they are open towards a fair worldwide trade. So the European Union is one of the most outward-oriented economies in the world. It is also the world's largest single market area. Free trade among its members was one of the EU's founding principles, and its commitment to opening up the world trade as well. Now, so I like this because as the world is getting more complicated, what I hope to see that the benchmark that I invested in, that why invest in them, because I believe that they want to be continue to be open and trade with partners. So to me, it's important because it's got about win-win. Collaboration is important. I think most of us will agree with that. So if European Union is having this mandate, then I think as we move along the timeline, it may range bound, but there's also opportunity that it may move beyond the range bound to a value stage. So that's my hope for the European Union, the Eurostop 50. And like what I say, the attributes is that in this time of uncertainty, that there's a lot of headwinds ahead. I could see that there's a lot multi-sectors around, as you could see that, and also the country as well. But I want to drill into these two countries because with this country weighting in Eurostop 50, who has the largest share? That you could see here is France with 37.8%, and followed by Germany. Germany is about 32%. So it's important to look at them. But earlier I mentioned about the European Union, their mandate, which is, it sits well with me as an investor. Now, next, let's look at what happened to France and Germany. Now, let's talk about Germany first. Is Chancellor. Okay, Chancellor is Olaf Scholz. Okay, yeah, I tried to pronounce his name correctly. Olaf Scholz. Now, so he's a new chancellor, quite new. And according to DW, he says that he is level-headed and pragmatic, which I like a leader of such. That means it goes beyond having ideas. I think the bottom line is about, when I read that, it's about, at the end of it, whatever idea we have, you still have to take care of the people, yeah, their livelihood, provide them a job. How to provide them a job is that trade is important. Okay, so therefore the European Union have this mandate that they want to continue to be open to trade around the world. So, and then for France, some interesting development that you also have to take note here is that on the 10th and 24th of this year, April this year, they are going to have their election. Result will be on 28th of April. And based on the current standing, I believe that Emmanuel Macron will continue to be a president of France. Now, then, according to Atlantic Council. They study into his as a person. They say that he is reality about the genuine nature of the problems, which it sits well with me as well. Again, it's not about having your idea. Yeah, of course, most of the politicians will have a certain idea how a country got to be run, all this and that. But it kind of boils down to, at the end of it, if your people have a livelihood, have a good livelihood, just not livelihood, good livelihood, the streets are safe, business are there. I think that's more important, right? So I think between these two gentlemen, it would be good if they continue to stay on from what I see. As an investor, I think we welcome that. It provides certain stability. Okay. Now, so that's what I see. Just a very quick update on what's coming up for France, especially election. Now, am I done with this? Let me see. Okay, yeah, it's very important. So where have the last maybe 50 minutes, so what is our topic? We are investing between the West, the US, and the European nation. So now do join us for next week, because I'm going to drill in even deeper about the topic will be trading between the West, US, and the European market, but I will focus on the Eurex itself. And we're going to learn about how to hedge in a time of uncertainty. And market uncertainty, I think, will be here for quite a while, and maybe moving down perhaps, but there's a way to overcome that. So I'll share on that, how to mitigate this risk, and also how to trade the European market. So I think a lot of you may be interested. So do tune in next week, the same time at 7:30. Now, before we go to the Q&A, just want to share with you, if you want to connect with me, yes, you could. You can connect with me through my Facebook page. It's Con Hao, the two names joined together. I just shared about on the 31st of March about the divergence. And next week, I'm going to discover with you in the Eurex market how to apply divergence to hedge the market and also to trade the European market as well. Now, so 31st March 2022, so I share about divergence. I mentioned what is divergence all about. You can go and read about it. Okay, so every day I'll post a market insight. I think you'll enjoy the read. Yeah. So also do remember to subscribe to Tiger Broker Singapore YouTube channel, and also my channel, Invest and Trade with Insight. And remember to turn on the notification bell so you will not miss any of my latest video. And I believe that we have Q&A. Let me see. Okay, I think what you can do is that the Q&A is open up right now. You can start to submit your question on the chat box. So we have some helper that's helping us to consolidate the questions. Maybe the first question I may kick off first, because through Hui's slide earlier, I got intrigued that, of course, I know that, but for those that join us later, right, I think it's good that you know this as well. Let me just flash the next screen, which is important. Yeah, okay. Now just exit myself for a while, or should I put it up myself? Okay, now I have one question I think is a very good question here, because it's relevant to me as a trader in Asia. So now, Hui is that, will Eurex extend more and more product during Asia hour? Would there be more product beyond just I mentioned about DAX and Eurostop 50?
Thanks, Con Hao, and thanks for the question. My answer is yes, because Asia has become a bigger force in the global financial landscape, and we are currently conducting market-wide consultations on the next phase of our extended hours. So this will include the extension of further products and services, and we are looking at new offerings to cater to the demands and needs of the Asian market. I hope this answers.
Okay, I'm definitely very excited. So, between the, I mean, all of us are very familiar with the US market, but definitely I'm looking for alternative. I'm still interested in the West, but I felt that what I presented here, I felt that as an investor, perhaps European market will offer me a safer haven but not now. I'm gonna wait as investor. But if you're a trader, do stay tuned for next week program. I'm gonna talk about more about trading, and Hui Si will be with us as well. Maybe I got one more question for you, Hui Si. Yeah, before we look at the question coming in, that now, so is Asian volume mainly driven by market makers? Now, because as a trader, I'm concerned that I trade usually up to about 2, 3 a.m., maybe about 2 a.m. Yeah. So sometime I may want to take position during the Asia time zone for the European market. So now, is the Asian volume mainly driven by market maker? Yeah.
Thanks again, Konghao. And that's a very good question. So I understand that this is the key concern. But if we were to look at the volume distribution during Asian hours, we have about 48% from the agency account, and that represents the end client flow. This shows a very healthy distribution of activity during the Asian hours. And that also shows that the order book is not just driven mainly by the market makers, but also the end clients, such as the retail clients, as well as the institutional clients.
Oh, fantastic. Okay, I think we have some question coming in, but we have time for maybe just 2 questions, and we'll just do just that. I think the next question will be for me. Maybe I just read it for myself to answer. Okay. Now, you asked me about, can you elaborate more about relationship between currency and inflation? Yes, I know that. I think it's very difficult to comprehend about currency and inflation, but let me give you this illustration. Last time I used to like to use the illustration about Mao Zedong durian, but this time I'll change my strategy a little bit here. Now, why when a currency weaken, it will cause inflation? Now, you think in terms of I think Singaporeans were very well traveled. I think we miss traveling overseas. Now, what happened when your currency is strong as you travel abroad? Now, when you travel abroad, just think in terms of that. Usually, you'll get you happy when you go to the money changer. If we have of course, I'm in Singapore. If I have a strong Sing dollars, say for example, I'm going to another country for holiday. So does it make sense that you should be happy about if you have a strong dollars? Means that I can exchange for other nation currency much more. I can spend more. Yeah, so a strong currency is important, but just think reversely. Now, if your currency is weak, so when you still have to import stuff, but means that you have to pay more if your currency is weak. So think in terms of, I know it's going to take you a while to digest them, but just think in terms of your excitement having a strong currency or home currency when you are going abroad. Yeah, strong currency is important, means that you can spend more. But reversely, the other side, having a weak currency, if put in that position that your home currency is weak, then when you go overseas to spend, you feel the pinch. So everything is so expensive. So I think it makes a lot of sense right now. Now, next one, I'm going to take on maybe the last question because we already exceeded the time. I think there's no time limit because the organizers say that there's no time limit, just take your time. But to respect the time of everyone, yeah, so that's maybe the last question. And maybe, let me see, any question that Hui Si, would you like to take on over here? Okay, maybe I will ask this question for Hui Si. Okay. Now, how is the liquidity of the Europe stock market compared to US? How's the liquidity in the European stock market compared to US?
Yeah, sorry, I was trying to unmute myself. So, well, again, this is very different. I understand that, most of the clients are very familiar with US market. And in terms of Europe, we believe that, there's stronger demand because the liquidity is also growing in the Euro market. So I would say worth taking a look in the, European stock market. In this case, there would be our Eurostop 50, which I mentioned is the most traded index at Urix, as well as the most traded futures in the world. Yeah.
Yeah. So next week, I'll be my topic about is trading between the West, between the US and the European market. Of course, my focus will be on the European market. I think your question about how is the liquidity in the European stock market compared to US is the similar for US market. It really depends on what stock you're talking about. Stocks, they are illiquid stocks. They are liquid stock in US also. There are plenty of illiquid stock in US. So same for European market as well. So choose that stock that with high liquidity if you want to trade the stocks. But definitely for next week program, we're going to talk about trading the Urix market. You're able to see the liquidity between the Eurostop 50 and the German DAX index futures. So you're able to see that we're going to talk about the liquidity of both markets. So with that, I think we're going to end the program. So thank you so much for all of you staying true. And I hope that you're enjoying this as much as we do. And I hope to see you again very, very, very soon. Thank you, everyone. Thank you, Tiger Broker. And thank you, Hui Si, for being with us.